It's always interesting these days to talk about fixed income. A few challenges ahead. I want to start with the Federal Reserve. Now that there seems to be more of a game in place, we know the tapering, more or less, has a schedule. I'll say more or less on that. We know that interest rates are going up, albeit probably not till 2015. So how does that change the way you strategize about fixed income investments?
Well, I think that the one thing that is the same is that investors are still going to be quite challenged to find income in today's market. The thing that we believe is going to happen with the Fed is that they will, in fact, stay on course with their quantitative easing, so that will be done before the end of the year. And the big question is, when will they start to raise rates? Of course, the market got a little bit misdirected, I would say, as to maybe how quickly versus how long they'll wait. We think it's going to be a mid-year 2015 event. And so as a result, we think investors between now and then should still be willing to take on some risk in trying to achieve higher income for their portfolios, rather than being too concerned about any dramatic rise in rates, similar to what we saw last year, for example, when we saw that 100 basis point rise over 4 months. While we think rates will rise, we think it'll be by a smaller amount and over a long period of time, so a more gradual rise, and do less damage to portfolios as a result.
So where do you take the risk then specifically in terms of holdings?
Sure. So the things that we don't like are long duration assets. So those are far more sensitive to a rise in rates and will have a bigger negative price impact on that smaller rise in rates. And we don't like very high quality assets. So U.S. Treasuries, agencies, where there's very little income cushion for an investor. What we like, therefore, is taking some credit risk. So we think the high yield market still, while not nearly as attractive as it had been last year and in the couple of years after the crisis, still we think will generate a decent return for investors, maybe mid-single digits over a 12-month horizon. And then we also like taking some credit risk in investment grade space. We think that's reasonably attractive. And then we think that there are select, and I emphasize select opportunities, when you look at emerging markets and some foreign currencies out there in the marketplace. But again, that is much more of a, what I would call a bond pickers market, currency pickers market today versus back a year or two when it was much more of an asset class play.